The key difference between today and 2011 is not price, sentiment, or headlines. It's position in the cycle. According to Peter Schiff, 2011 marked exhaustion, not opportunity. Gold and silver had already completed a decade-long advance that began in the early 2000s, with gold rising from under $300 and silver climbing from just a few dollars to historic highs. By the time fundamentals looked obviously bullish back then, much of the upside had already been pulled forward. The market had priced in years of monetary easing before it fully arrived, and what followed was not failure, but a long, grinding consolidation that drained interest and conviction. Schiff argues that the current environment is the opposite. Gold only broke free from that consolidation in 2024, silver followed in 2025, and mining stocks are now just beginning to emerge from a decade of suppression. In his view, this is not the end of a move. It is the opening phase of a much larger one. What makes this phase different is who is driving it and who is yet to participate. Peter Schiff points to central banks as the anchor of demand, not only continuing to accumulate gold, but expanding participation across a wider group of buyers. Institutions are beginning to move, retail is waking up, and momentum is spreading beyond a narrow buyer base. That raises a simple but dangerous imbalance. Nearly everyone is positioning to buy, yet very little new supply exists to meet that demand. Mining output cannot be scaled quickly, inventories are thin, and there is no hidden pool of metal waiting to be released at higher prices. Schiff believes this is where price becomes the pressure valve. When demand broadens and supply cannot respond, metals do not rise politely. They gap higher, forcing repricing across the entire complex. Silver, in particular, sits at the center of this pressure. Schiff views silver's recent surge not as speculation, but as confirmation that the bull market is maturing into its more aggressive phase. Historically, silver lags gold early and then outperforms sharply once confidence breaks in paper assets. That pattern is now playing out, and it carries powerful implications for mining companies. In this video, we'll break down the forces reshaping the gold and silver markets, from supply chain pressure to institutional behavior. If you value analysis that looks beyond price and into structure, be sure to like the video, subscribe to the channel, and stay with us for the full discussion.
This is the beginning of another big move because, the bull market in gold and silver and mining stocks started around 2001, 2002. And so 10 years later, we had gold move from below 300 to 1900. Silver had moved from $4 up to, over 45. So you had a 10x move in silver. You certainly had a 10x move in a lot of the mining stocks. So a lot of money was made in that early leg of the bull market, and much of it in anticipation of what ultimately happened in 2009, 10, 11 with all the quantitative easings and 0% interest rates. Gold was way ahead of that. And then we basically went sideways for more than a decade. Gold didn't really break out of that consolidation until 2024. Silver didn't break out until 2025. And the mining stocks are just breaking out, really. Even though they've tripled or quadrupled from their lows, they're just getting back to the 2011 highs. Some have exceeded those highs. Some haven't quite gotten back there yet. But I think what's happening now is we're just beginning a new leg of this bull market. So I think today is a lot more similar to 2001, 2002 timeframe than 2011. So I think, you're not getting in at the rock bottom if you get in now, obviously at $4,800 gold and $94 silver. But I think you're getting in closer to the bottom than the top. And certainly with mining stocks, that's the case. I think there's an even more compelling case to be buying the precious metals miners right now than the precious metals themselves. They're not going to be the drivers, but they're certainly going to be going along for the ride. I mean, they're going to be participating. But what I think is going to happen, and is already happening, is central banks will not only continue to accumulate gold, but the banks that have been accumulating will accumulate more. and those that haven't bought any will start. So you're going to see, more wider participation by more central banks. You're going to see the institutional investors start to participate. And I think that's starting in the space, particularly in the mining stocks. And you're going to see retail. And so everybody is going to be buying. And so the difference is in 2024 and mainly 2025, it was mostly central banks, not a lot of private investors, whether it was institutional or retail. But now they're all going to be buying. The question you have to ask yourself is, who's going to do the selling? Where is the metal going to come from? So obviously it's going to come from the mining stocks, and they actually can't produce that much. So prices are going to soar, profits are going to soar in the industry, and I think investors, after a long time of waiting, are finally going to be rewarded for their patience.
Okay.
And they are being rewarded right now. Obviously, the people that have already been in the trade for as long as I have. But that doesn't diminish the demand for gold. It means that, yes, you don't have to buy as many ounces of gold, but you have to commit more dollars to buying less gold. But the demand is going to be there because people need to have it, right? I mean, they're just going to have to pay more for it. But that's going to be great for the mining companies. I mean, they're going to sell every ounce they can dig up. It's not like they're going to have a surplus of gold that they have nothing to do with. They're going to sell all the gold they can dig out of the ground, and at much, much higher prices because they can't dig it out fast enough for the money. Think about all the trillions and trillions of dollars and euros and pounds and yen and RMB, all these currencies chasing a very limited supply of gold. And they keep creating more fiat currency every day, right? The central banks just create it out of thin air. So the demand just keeps growing for gold because it's being fueled by the banks, which is being fueled by the governments that have made promises they can't keep, and they have debt they can't repay. And so everybody is creating inflation, right? I mean, all the roads lead to gold because every road is paved with inflation. Fundamentals for silver are great. I mean, first of all, silver is now catching up to gold because gold, kind of was the only precious metal moving for the last couple of years. And now you got silver, you got platinum, right, following gold's lead. In all bull markets, precious metals bull markets, you would expect silver to outperform gold. And now that's happening. And that's going to continue. I think you're going to continue to see more appreciation, albeit with more volatility in silver than gold. But both metals have a long way to go from here. And the fact that silver is now leading is a positive sign for gold. It was always kind of a knock on gold that it wasn't being confirmed by silver. And there are a lot of people that thought, well, it just means gold's going to sell off. And that's how, you're going to get the valuations come back to normal, is not with silver going up, but with gold coming down. And I always believed it would be the opposite. It would be gold catching up. And, I've been proven right on that forecast because silver has, made up for a lot of lost ground. And so, the metals are going higher. And I got, a lot of silver. I have silver mining stocks. But of course, all the gold mining companies also mine silver. People forget about that, right? But a lot of the mining companies, the gold miners, they don't report silver as a revenue item. They use it to offset their costs because it's a byproduct of gold. So the higher the price of silver, the cheaper it is for them to get their gold. So if you think about these mining companies, their two biggest costs, other than labor, are energy and then what they get from their silver. And energy is cheap. It's as cheap as it's ever been. And they're getting more money for their silver, which reduces the cost of mining gold. I mean, they can make so much money off of silver, they might get the gold for free. Who knows? But silver that they used to get $20 an ounce for, $25 an ounce, they're now getting $95 an ounce. That is a huge difference for these mining companies. And of course, it might cause some of the gold mining companies to try to focus. Maybe they got some silver they haven't really been paying attention to.
The real threat facing the U.S. economy right now is not a soft landing, mixed data, or temporary slowdowns. According to Peter Schiff, the United States is heading toward a crisis that eclipses 2008 in both scale and consequence. This is not just another recession or financial accident. It is a sovereign debt and currency crisis forming simultaneously. Gold and silver, in Schiff's view, are already signaling a fracture in the global monetary system, with the U.S. dollar sitting at the center of the stress. As central banks replace dollar reserves with gold and foreign capital begins flowing back home, the U.S. loses the external financing it depends on to sustain massive trade and budget deficits. That shift alone is enough to destabilize the entire structure. The strength of the stock market, Schiff argues, is not evidence of economic health, but proof of inflation distortion. Nominal prices are rising, but real value is collapsing. Measured in gold, U.S. equities have been in a long-term decline for decades. Inflation lifts asset prices while quietly eroding purchasing power, and most Americans never benefit from those gains anyway. They feel the damage through rising living costs, stagnant wages, and the need to work multiple jobs just to stay afloat. A rising Dow does not reflect prosperity. It reflects a weakening currency masking economic decay. When this next crisis breaks, Schiff believes the traditional response will fail immediately. Money printing and rate cuts may have delayed consequences in past downturns, but this time they will accelerate the collapse because inflation and dollar weakness are already the problem. Stimulus will not stabilize confidence, it will destroy it. Unlike the 1980s, the U.S. cannot survive high rates due to overwhelming debt, yet it cannot print without detonating inflation. In Schiff's framework, there is no soft outcome left.
I think the U.S. economy is in a lot of trouble. I think we are on the verge of a much worse economic crisis in 2008, because I don't think it's just a financial crisis, but a sovereign debt and a currency crisis. I think we're on the cusp of that right now. I think that's what gold and silver are signaling, a breakdown in the monetary order, and the U.S. dollar is at the epicenter of that order. Central banks are going to be replacing their dollars with gold, which, cuts out the demand for U.S. treasuries. I think global investors are going to be divesting of U.S. stocks and bonds and moving their money back home to invest locally. And this is a game changer for the U.S. We depend on those capital flows. We depend on the rest of the world to finance our twin deficits, the budget deficits, the trade deficits. We depend on the world to supply us with the goods that we don't produce. And so all this is coming to an end. And, people are oblivious, just the way they were oblivious to the 2008 financial crisis, even when it was just weeks away. They still couldn't see it coming. This is a bigger crisis, of course, than that one. But the same people who were blind, in '08 are just as, blind now. The stock market was strong under Biden, right? And, the economy was weak under Biden. That's why Trump was elected. In fact, the economy was strong the stock market was strong during, Trump's first term. In fact, it's been strong pretty much for every president. Look where the Dow was almost 50,000. It was at 10,000 in 2000. But gold was at 260. Now it's almost 5,000. So if you measure the price of the stock market in terms of ounces of gold, it's not strong. It's extremely weak. Dow's down like 70% over the last 25 years. So we don't really have a strong stock market. We have a lot of inflation. Inflation makes prices go up, and that includes stock prices. So just because we have a rising stock market, it doesn't mean that we have a strong economy. It could indicate that we have a lot of inflation, which in fact is what it does. And the majority of Americans don't really own stocks. And so they're not getting the benefit of stocks going up. But what they are having to deal with is the pain of the cost of living going up. That's why people talk about the affordability crisis, because inflation has driven up the price of everything that Americans need to buy. And the one thing that hasn't gone up nearly as much is their paychecks. And so what they have done to try to make up the gap is to work more, have second jobs, have third jobs. Inflation is going to get worse, right? Donald Trump wants to brag that inflation is gone. It's not gone. It's going to be here and with us and worse than ever. And the big problem is that every time the U.S. has an economic problem, whether it was, the bursting of the dot-com bubble, or even before that, long-term capital management, or, we had an Asian crisis or Latin American debt crisis, but then the 2008 financial crisis, and then the COVID pandemic, our solution has always been create inflation, print money, slash interest rates, stimulate. But this coming crisis, not only won't that work, it will fuel the fire. Because when the problem is inflation, the problem is a weak dollar, you can't solve that problem by weakening the dollar more. You can't just print a bunch of money and try to solve an inflation problem because you just make the problem you're trying to solve immediately worse. And so we're in a situation now where everything that's worked in the past, at least from the perspective of it's enabled us to kick the can down the road and pretend that we solved the problem that we actually just made worse. But now the solutions not only won't, make people feel better in the short run, the immediate impact will be to make everything worse. So, we have not experienced this since the 70s. And we were willing to deal with it in the early 80s with 20% interest rates and, stuff like that. But we don't even have the capacity to do that now because the numbers, the debt is now so large that if we swallow the bitter tasting medicine that we swallowed in 1980, we'll die from the medicine. So we either die from the disease or we die from the cure. Survival is not even a possibility here.
The next move in gold and silver will not be driven by hype or speculation. It will be forced by necessity. As confidence in paper assets continues to weaken, capital will rotate toward monetary metals for protection rather than profit. Gold will lead as institutions and sovereign buyers reposition, while silver will follow with faster, more volatile advances once supply tightness becomes impossible to ignore. This shift will not depend on new narratives or catalysts. It will emerge naturally as pressure builds across the financial system and alternatives disappear. As prices rise, speed becomes the defining factor. Gold is likely to advance in measured but relentless steps, absorbing large flows quietly, while silver reacts violently to even small imbalances. Limited inventories, thin liquidity, and rising industrial demand will collide with monetary demand at the same time. When that happens, silver will stop trading like an industrial commodity and begin repricing as a monetary asset, with moves that feel sudden rather than gradual. The real question is not whether gold and silver move higher, but whether most investors will recognize what is happening before prices accelerate beyond levels that once seemed unthinkable. Share your thoughts in the comments. Your perspective might help someone else see the bigger picture.